Being great at spotting a trend can set you apart in the financial world from everybody else. In this video, I'm going to get right into how you can understand market trends and how that can be your golden ticket to building wealth and getting you started right away. Okay, so number one, where do you start? Like with all the news and all the information out there, it's almost like it's an overload, isn't it? So how do we know where the right places to look? Like what are those market trends or the types of markets that we should be watching? Now, I'll tell you, I like simple. I believe that simple is better. In fact, I even like to quote Leonardo Da Vinci when he says, simplicity is the ultimate sophistication. And that's true. You want to make sure you get right to the core of what works. So here's what I follow. Now, I'm not saying you should always follow what I do, but these are the kind of things that I look at because you want to make sure that you're following the right markets and you want to follow the markets of what good people do. Now, let me give you just a bonus here, right? Just to give you a start. If you're here right now, if you're watching this video, you're on a great path, right? This is good. Find people that actually are informed. I actually listen to people too. I'll give you an example of a guy that I think is great, although I take all of his stuff with a grain of salt, is Bert Doman, right? He has the Wellington letter that he does as a subscription. I actually subscribe to that. I pay the, whatever it is, 59, 69 bucks a month to be a part of that letter. Now, I'll tell you, not everything is accurate in my opinion, right? But he's got a lot of good points that allows me to shift and know what to do. But I think the first thing, if you're gonna really start somewhere, even if you're gonna subscribe to these different people, even if you're listening to like Robert Kiyosaki, right? And you're wondering what he's saying, and sometimes he'll say some things you're like, dude, is this guy going crazy or what? You know, but who knows, that crazy might be right. It's good to hear different views. It's even good to hear views that maybe you don't agree with, right? I actually was watching some Dave Ramsey videos the other day and actually found a lot of things I do agree with him on. And so I was really impressed by some of the things I did hear versus a lot of the things that I do hear as well that I don't like as much, right? So remember, you can actually go and listen to other people, but take everything with a grain of salt and come back to one key place. And this is something I wasn't gonna share in this video, but this is really what helped me the most, is understand economic principles. If you understand true economic principles, and there's a lot of them, but I'll give you a few short ones here that really make a difference. Economic principles mean everything. Now, the economy, a lot of times you talk about economics, it's like the study of scarce resources, right? They're talking about scarcity. And although scarcity is a part of it, really what it comes down to is there's the economic piece that seems like the logical piece, but there's also the human emotion piece that combines with what's going on with finances and the economy and everything else. So when I look at the economy, I'm looking for things such as what's the flow of money? Because one key principle is this: exchange creates wealth. The faster that money exchanges hands, the more wealth everybody creates. This is true even in your own life. If you want to have more money coming in, the more you get paid, the better. Imagine if your paychecks, the same amount you get paid normally, imagine those paychecks instead of coming like once a week or once a month or twice a month, instead came once a day. What if all of a sudden you got paid that same amount you got paid bi-weekly, you got paid daily? Would that create more money in your life? Heck yeah, it would. But it wouldn't do you any good unless you actually did something with that money. Now you might say, well, I'll put it into savings. Okay, great. Well, still, the bank is gonna leverage that money and get it out, right? They're just gonna use that money to make more money themselves. So if there's more money in the banks, that means more money gets lent out. Usually means that more money gets lent out. That's assuming the banks are also willing to exchange money, right? So when money is exchanging hands, when you're spending money and going to the store, people make more money. So think about this with the invention of the internet. And to the late 90s and into the 2000s, there was that big, huge tech boom because the internet made everything faster. It was no longer dealing with snail mail. Now we could do things online in the middle of the night. You could get paid literally while you sleep if you have a product that you're selling online. That changed the world. It revolutionized things, making everything faster. That made people more money. Not because there was more money in the market, but because there was more money changing hands. Understand, you can have the same $100 bill, but if people pay it and exchange it fast, multiple times in a day, you can make multiple hundreds of dollars a day with that same $100 bill. That's true with money in general. The greater the flow of money, the more you make, and the more that everybody makes. This is why in the Great Depression, when everybody got scared and they started holding on to money and holding on to it tight, whatever little that they had, that scarcity, that fear created a deeper depression. In fact, it was even worse when you had guys like Franklin Delano Roosevelt saying, let's tax the rich up to 100%, which eventually Congress said, okay, that's dumb, let's not do that. But this tax the rich more and more, take more money out of their hands, but the problem is that you put it in the government's hands and then it goes bye-bye, doesn't it? So if you want to make anything more expensive, just give it to the government. So that's the problem, guys, is that if you want to have more money, you got to have more exchange. Even the banks, what they talk about all the time in the news, they'll talk about the banks. Well, the real thing about the banks is not whether they have money, but whether they're actually still lending money. Because when they stopped lending money like they did in 2007, 2008, and I was there, I remember in 2007 it had already started. When they stopped lending money to real estate investors and to business owners, that locked it up. Now all of a sudden, business owners and real estate investors had to contract. Either they had to sell things off or they went broke, literally. And when people go broke, then they don't have money to pay you. They're not going to the store to pay them. Then, of course, the stores make less money. Then they have to lay off employees and they have more layoffs and everything shrinks. This is why when people talk about the feds, right? The feds, you know, what are they going to do with interest rates? What they're trying to do is slow down the rate of money exchanging hands, right? And ultimately, it's only going to slow down when the banks finally say, okay, we're going to stop lending money as much. Because as long as they kept pushing money out left and right, companies could keep growing, they could keep expanding, and that creates more inflation, right? So understand that whole exchange principle, even just understand that one principle, makes more sense. Then you can kind of sift through all the crap and things that people say in speculation and say, what does this do for money supply and money flow? I will just say this as a big, huge thing. If you get nothing else from this, understand this. Ignore most of the news you see out there today. Most of the news, they're just trying to really reiterate the same crap that they already said the previous 10 times, right? They're just trying to come up with something new. But most news is not new. Most news is just people talking to give you stuff. Hopefully just learning about this exchange principle was news for you. It's information, something that gives you a bigger insight, something that gives you something more. Unfortunately, most news doesn't do that. They're just reporting what they hear or what they see. But that's it. There's not really anything new. So the type of markets I like to watch, and I'll tell you, this is one of my favorite things to do, is I like to watch what's happening to you as a consumer. Now, that sounds creepy. I know it makes it sound like I'm a little creeper, like with little binoculars. I like to watch you. I'll be watching you. No, it's not that crazy, guys. I'm not talking about that. I'm talking about, like, I want to look at things like credit card balances. Are credit card balances going up? Because if they are, that's a sign that things could be moving to recession. If balances are going down, that means there's extra cash in people's lives to pay it down. 2020 was interesting because we saw credit card balances go down. Not because people made more money. Well, it was because people made more money, but not in the traditional way you'd think of. It's because the government started paying you checks. They tried to do all this COVID bailout, right? And they're throwing more money in the market, which of course created a bigger bubble than we already had. Just so you know, going into 2020, we were already about to head into recession. The bubble was about to pop that we already saw. There was already a big bubble at that point. And then they just threw in trillions of dollars more money to create a bigger bubble that now could lead to a much bigger recession as a result, right? The bigger the party, the bigger the hangover. So you got to be careful of that. So understand that as money's being exchanged, it can make a difference. So I look at credit card balances. 2020, they went down, but guess what's happening? Now they're starting to go back up. That's a sign that things are getting harder on the average American. Also, look at savings rates. How much are people able to put away into savings? Is it going up or is it going down? Look at auto loan defaults. Because auto loans, as I mentioned in another video, auto loans like mortgages, right, like your home, that's the thing that's kind of a necessity, especially if you work. If you commute to work, you need transportation. So if you're defaulting on an auto loan, you know it's serious. That's even worse than credit card defaults. Because now, or credit card balances, now we're seeing that people are defaulting on the things that they need. So looking at that, looking at foreclosure rates, all of these things are telltale signs. You know, all the unemployment numbers, anything that's government reported, you got to take that with a grain of salt. That's the problem. Because when the government likes to report it, they like to skew the numbers and make it look better so they can get reelected. And so you see this unemployment rate and you're saying, wow, it's 3.4%. That's an all-time low in history. How is that possible? How is it possible I'm hearing people get laid off left and right from tech companies, but it's still going, the unemployment rate's getting better. It's going down. It's not, guys. It's because they're manipulating numbers. Same thing with inflation. Inflation I pay attention to a little bit, but I'll tell you, even inflation's been manipulated so much that it's not great to follow. Now, when I'm following the feds, here's a cool thing. If you want to see what the feds do, here's what you follow, because this is what the feds are following and they won't tell you. The feds aren't that creative. Now, they're following a few little items, but for the most part, if you watch historically, the feds actually follow like the 2-year treasury yield. If you ever look that up, you can go to like Yahoo Finance, look up the 2-year treasury yield, or even just Google 2-year treasury yield. You can see charts. You'll see that when the yields go up, they say, oh, we're gonna raise rates. And then historically, as those go down, they start to lower rates. Guess what? Before 2020, those yields started coming down. And what did the Fed start doing in 2019? They said, oh, we're gonna start bringing those interest rates down a little bit. So they started going down, following that trend line. And then of course, 2020 happened and then, those rates dropped and so did their rates. They follow rate suit. Feds aren't that original. They actually just follow what they see on those treasury note yields. So very important to watch that. And you'll basically be able to predict, and you'll look like a freaking prophet. You're like, wow, how'd you know that? How'd you know they're gonna raise rates? Because that rate was going up. That's how I know, because they watch that rate too. They'll say it's unemployment or it's based on inflation, but that's a little bit of it. But really they're following that. They're following those treasury yields. That's what they're actually following. So again, guys, ignore most of the news. Most of it's just trash anyways. It's just trying to get you riled up and click on that stuff. It's like clickbait. Maybe this is clickbait for you, but hopefully this is actually valuable for you versus being clickbait. By the way, if this is valuable for you guys, please put a comment below. Tell me if this was good, important stuff for you, and subscribe to our channel as well. And if you think this is good, we got more Make You Rich videos that you can check out as well.